Welcome to episode 73 of Talk Your Chart. I am Marco Segura here with the always wonderful Brett Horowitz. And today we are talking, what are we talking about, Brett? Shall we go with AI? Ever heard of it?
Go for it. Artificial intelligence, that's in all the news now. Is it a bubble? Is it not?
Yeah, I don't know. Eventually it will be. Who knows when? Let's start this out with something that I found out, and we can throw the Arlena bubble chart while I share this. I didn't know. All right, I guess I should really appreciate. Do you remember when someone rather famous mentioned a phrase known as irrational exuberance?
Alan Greenspan, 1996. I don't know the exact date.
It was in December. I don't know the exact date either. 1996. That means that it was over 4 years later that the market actually cratered, and when it bottomed after the tech bubble, it actually bottomed at a level that was higher than when Alan Greenspan did his irrational exuberance talk. I didn't appreciate that, and I think that is a wonderful little perspective sharing story. So, whoever the Alan Greenspan is of today, we appreciate you sharing your sound opinion, but who knows when that bottom's going to come in. So anyways, this chart, BH, wonderfully branded, is showing us a comparison of is it forwards? That's the forward PEs for the blue chips then and the blue chips now. And it is hilarious to see Cisco's trading at 130 times. So I knew there was a difference. I didn't expect it to be this staggering of a difference. And this just goes to show you, man, are these companies printing money or what?
Yeah, I mean, Andrew Ross Sorkin, maybe the most high-profile guy talking about a bubble now, who's on 60 Minutes and wrote a book called Bubble, and he's on CNBC every day talking about
No,
this.
isn't the book called 1929?
All right, yeah. It's about the bubble, yeah. Great Depression. To the point about how different it is today versus the 1990s and 2000s, right? I mean, a few years ago, NVIDIA, I think, had a PE of over 100. I think we started talking about these episodes. And now just the amount of revenue they've been making and these other companies, it's very different. You don't have these .com companies making nothing, and you're just praying that they are. They're making a lot of money. They're spending a lot of money too, as we talked about last time with OpenAI and other companies. And they're all spending on each other. But as of now, they're being rewarded because the earnings on these companies, for the most part, have been really, really strong.
Yeah, they need to be stronger. Eventually, the revenues have to turn to bottom line. And I've listened and read long enough. The constraint seems to always go back to energy. That's why, for example, I know that the sun is 99% of the mass of our solar system, because it's kind of funny if you spend enough time reading or listening about AI, it always ends up with the sun because we're going to need a lot of energy to keep this train rolling. So who knows? Let's see. I showed that chart 2 months ago, 3 months ago about China just absolutely lapping us in energy production. So we need to get on we need to get on that bus, brother, and start harnessing the power of the sun.
Well, look, there are probably going to be some companies that do overspend and do fail, and not fail in terms of like Google going to zero and NVIDIA going to zero, but just get some decisions wrong, and the market's going to punish them for that. We're not saying every company is going to work out, but that's what a market cap weighted index does. Like the S&P 500 is those companies that do what they say they're going to do, become stronger and stronger, become a bigger part of the portfolio. Those that become weaker become smaller and smaller. So you don't have to pick the winners or try to pick the losers. You just know that the stronger will rise to the top and the losers will fall down. And so I'm not worried about some companies getting into an arms race over who's going to spend the most for their AI. We'll see the results and it'll happen in the portfolio. And I don't want to try to pick who's going to win or not.
Yeah, and you must have been reading the tea leaves on these charts. I just moved the chart around to make it the second one because you provided the perfect little segue. This is from our close friends at JP Morgan Asset Management. Top 10 S&P 500 companies by market cap: 85, 95, 05, 2015, and 2025. And they do us the wonderful little favor of color coding the companies so we know who drops off and who stays on board over each rolling 10-year period. And if my calculations are right, and they're probably not, it looks like about 20 to 30% of the names change every 10 years.
But yeah, I mean, nobody from '85 was left. Only two were left in 2015, and none today. Poor J&J is going through some nervous now with their aspirin or Tylenol.
Tylenol.
Tylenol, yeah.
When's the last time you had a Tylenol?
This weekend, I had some back spasms.
Really? Oh, you
Tylenol.
know what
I'm
that
not
is?
pregnant, so it's okay for
Oh,
me.
here, let me do you a favor. Brett, do you perhaps have back spasms because you outperformed yourself on the Peloton compared to your 2021 version? Tell us
No,
more.
can't be it. Can't be it. Something else. Probably
Yeah.
slept wrong.
Yeah, for the listener out there, the 2025 version of Brett outperformed his 2021 counterpart on Peloton. Um,
Thank you, but it was like one every four times that happened. So three to four times it does not happen. I am getting older.
a bastion of hope, brother. If you can
But
do it, then quite literally everyone can do it,
but
right?
back to this chart. I mean, it is impressive to see the names that are on there and how big the market cap's on. Right, NVIDIA hit 5 trillion market cap the other day. I think a couple other companies were at 4 trillion, if I remember.
Yeah, the market caps are pretty incredible. I can't wait for the first RA to have $1 trillion under management. That'll be fun.
Probably not going to be us.
I never say never. Yeah, so look, this chart does a wonderful job of letting you know the winners are the winners until they aren't. What's also interesting, and I don't have a chart to pair this with, but even if you fall off the top 10, it doesn't mean that you went out of business. It just usually means that someone had such outsized and unexpected performance that they just made the cheese move, right? That's it. So it's not that we need JP Morgan or Broadcom or NVIDIA or Apple to disappear for them to drop off this list. They just need to underperform on a relative basis compared to some new up and comers that are just kind of ripping through. And that's what happens over the past decade.
Harold Davensky used to talk about what happened in 2007 when the market took a big pullback, or even in 2000 where clients were so worried about their money dropping down. And he used to always use the example that Kodak and Fuji were taking pictures in Disneyland, and clients were still spending money, and it wasn't like all these companies went out of business. Kodak was on that list in 1985. I don't know if they're still in business these days, but for
Yeah,
most of the rest of them, they still are in business. They're just, to your point, not as big as they were before.
yeah, no, yeah. Hopefully, your entire net worth wasn't tied up in Kodak or Royal Dutch.
Or
But
Amoco.
if you own the market, that's what it is. Oh, and let's do a quick. I didn't do it because I did it once before. I almost brought up the Besson Binder study again because it's making the rounds again on finance Twitter or X. Appreciate that it's under 4% of the constituents in the market are responsible for like over 95% of the gains. So again, the risk is not buying something that's going to go to zero. It's buying something that just doesn't participate in the magnitude that you could have if you buy the haystack. Sorry, it's just not in
If
my favor.
anybody has not read Harold's book, Hello Harold, and wants a copy, let us know, because there's a chapter in there, Good Company versus Good Stock. And it basically goes through a quick little discussion about a client who wants to buy a company. He spends hours and hours doing research on a computer that he wants to buy. And then he wants to buy a company and doesn't know the CEO's name, doesn't know the competitors, doesn't know the revenue or the market share or this or that. And Harold's point is basically saying, look, you spent more time on this personal computer than you did buying a stock. It's not going to work out for you most of the time. Even professionals don't get it right most of the time. So it's just a losing situation to try it on your own.
Yeah, I'm game on, brother. What do you want next? Oh, you know what? Do GDP because I want to talk about GDP.
I want to talk about pigs. We're talking about a term from the early 2010s. Pigs, Portugal, Italy, Greece, Spain. Remember those countries?
I do.
This was all of the hubbub back then because all these countries had huge amount of debt and they were spending irresponsibly. They were forced to put all these austerity measures in place. A lot of the government got kicked out. Interest rates were screaming high. It was literally one country after another. And now it's interesting to see that those countries have really gotten their debt under control. I mean, we can see here that Greece and Spain and Portugal have much lower budget deficits as share of GDP. 3% is what's written into the EU treaty that they need to be below. And now you have other companies like France and Germany and the Netherlands that are either above that or high. And it could be a problem. It's not necessarily one. Thankfully, the countries like the pigs enacted a lot of structural changes. They changed retirement ages. They streamlined their bureaucracy. They privatized industry, overhauled labor laws, and they're growing. Spain grew 3.5% last year. Greece 2.3%, much higher than France and the UK. So while these countries like Germany are spending a ton on infrastructure and defense, and President Trump has been pushing them to spend more on their defense, you got to worry that they could be in the same situation as the pigs 15 years later, but just a different group of countries.
Yeah, so what do you think? You have GDP outside the US accelerating slower or faster than in the US?
Right now, for the most part, slower.
Yeah, I can't, like, I don't know what case you make to say otherwise. You know what's awesome about that? The respective country, continents, whatever you want to say, is stock market performance is not going to care about their GDP performance to some extent. And that's
Right.
always been that funny kind of emerging market play. Well, every time, and this is something I always bring up on the on our investment committee when we do our CMAs or capital market assumptions, which is the fancy word for expected returns. Every time I see emerging markets with the highest expected return, I just I want to light CMAs on fire whenever I see that.
But yeah, there was a study that I read, this is probably 10 years ago, that basically said China has been growing at, I don't know, 3 times the rate that the US has been growing for the last 10, 15 years. And yet their return was like half of what the US did. So yeah, it's not just the GDP, it's not just the growth of the country, not the economy. There's a lot more factors about currency, about stability of government, about where you start, right? If you're starting at a very high point, it's very hard to continue that. If you're starting at a very low point in terms of the price to earnings, you're likely to have higher returns going forward. So there's a lot more than that, but something to pay attention to. We may see countries like these in the news soon if we start to see the interest rates start to spike.
Yeah, look at I mean earlier this year, I know you didn't say it on the show, but correct me if I'm wrong, you sold everything and you invested all of your money in a China ETF this year, right?
I did Europe because Europe is up 30% this year, so I put everything in Europe, and
No, isn't China? China's beating you. It's got to be.
China's being Europe. I took Europe because Europe's a little more safer to me.
Did you do like the Euro Stocks 50 or you did something else?
Yeah, just to diversify it across all of Europe.
Let me see. China's winning.
China's beating Europe.
Yes, it is. Look at you. Great move. So back to GDP, and here's why I wanted to bring it up.
Look, I'm not trying to pick the best of the best, okay? There's always something better than China. I could find something better than China. That's not the point. It's that China and the Europe beat the US in spite of all these challenges that Europe is having.
Yeah, I hear you. Remember summer of 2022? That was a great little European note. So back to GDP and things I want to light on fire. Our good friend Jerry Powell and his friends, they come up with a summary of economic projections. And I think whatever comes out in the summary of economic projections, you just have to take as what's definitely not going to happen. This, remember when they thought the Fed funds rate was going to be at 0.7% in June of 2023? Whoopsies, that was horribly wrong. They now think GDP is going to increase by basically less than 2% until, well, I guess they give it a range, like up to 2 through 25, up to 2.6 and 26, 2.7. We're clipping threes to fours. I don't, what are they?
We did have a negative in Q1, a big positive in Q2, mostly due to importing, right? So it skewed the numbers a little bit.
Yeah, it did, Brett. It did skew the numbers. Let me talk to you about this right now. So Q3 earnings per share tracking to a record high. That's awesome. Forward earnings per share, as you well know, coming up on $300 as a year-end target, and through forecast to be $350 on the S&P by end of 2026. Earnings growth for Q3 It looks like it's going to be more than 10%. And 6% was expected. And by the way, those analysts did not revise down like they usually do. Pro forma is up like crazy. All 11 sectors are beating earnings, which is weird for insurance and healthcare. And equal weighted indexes are underperforming. And that's, yeah, and that's, let me pivot to a chart before I lose momentum. So what I was just kind of looking at, and it's so sad, it's so frustrating. This next chart here from our good friend Sir Ed Yardeni is showing us all those forward earnings growth. And again, bull markets don't die of old age. There's going to be something we kind of don't expect that just comes in and ruins everything. Everyone actually doesn't like AI. There's no productivity gains, or we do need to harness the power of the sun for it to actually happen. Who the heck knows? But this chart is just frustrating because for folks who have a small cap bias in their portfolios, we really need these small cap companies to start making more money. And we can really see in this chart who all the earnings have accrued to. And the red are the big guys, the green are the small guys. You see just coming off 2022 and the rip roar that everybody got, they've just tailed off. And in a credit environment that's now getting a little bit less wonderful, especially with all the headlines and cockroaches that we're seeing, what's the case for small caps, BH? Why own small caps?
I wish the investment committee listened to you because you picked large cap as your investment of the year, which seems to be pretty proficient at what's going to happen. I think last time I had read over 80% of companies had beaten their earnings so far this quarter. So it's been a really great quarter. That's obviously why the market has done so well this year. You know, clients like to focus on the negatives about what's happening with the tariffs and what's happening with politics, and what's happening with unemployment and jobs. But this is the real crux of why the market's done so well is companies are making money. They're beating their earnings. The big companies are getting bigger. What's going to change this? I don't know. Maybe the big companies get too big, and so there's some pullbacks there. But yeah, you need small companies to step up. Hopefully with lower interest rates, that will help them, right? Because we do know that interest rates are more tied to the small companies who have to do more borrowing than the big companies.
Yeah.
Maybe there's a positive in there. But I don't know. We've been waiting for this for a long time. It hasn't happened yet. So I don't know when it's going to happen.
Yeah, I know. A credit event crushes small caps more. It's just without a shadow of a doubt. But consumer still looks good. Who the heck knows? And then all that optimism, I like to check that consumer sentiment chart and the American investors something survey, the one that says how stocks are going to perform over the next 12 months or whatnot. That one's looking elevated, and that one is always good for a kind of rollover. I think if it's over 4, it's kind of a signal to kind of maybe again chips off the table, just rebalance type thing. So I went to the consumer sentiment survey thinking, man, this thing's going to start approaching that average of 84. And I was surprised to see it sitting in October, end of October, at 53.6, brother.
This is what the Fed should use to make their forward predictions. Forget whatever reports they're looking at because they always have great information, although now a little bit less because some of the government's shut down. But just use this to make your decision.
This makes me feel so good because this has gotten to be, at least so far, one of the most hated bull markets ever.
Unless this is replied to as little as the job survey is replied to.
I don't know, man, but just look at the indicators going back, right?
Maybe there's only like 3 people that are replying.
I hope they keep doing whatever the hell they do, man. The best part is that subsequent 12-month returns are positive, whether it's at a peak or a trough, which is awesome. But again, this just screams irrational exuberance is not here yet, right? Everyone's waiting for the thing to go wrong. And all these private credit headlines, I like them because the more it's in the headlines, the less likely it is to be an issue that torpedoes everything. And there you go, man. So sentiment.
I'm surprised. The only one thing I'm surprised about is in January 2000, it was above 110. I'm surprised that you could have an index that goes above 100 if you're asking questions. So what that would actually mean. But yeah, we're nowhere close.
Brother, you know what that is? That's the real irrational exuberance that your friend talked about when it was only sitting at 90. That's what it takes.
Looks like it was also near 110.
No, it's closer to 90.
96?
Yeah.
Well, it's hard to tell in the chart.
I mean, but I'm not blind. I got like a ruler here. Last thing. So let's start where we ended, or ended where we started. PE ratios. What's the forward price earnings ratio on Costco right now? Which I always just use as kind of a benchmark. Um,
12.
isn't that awesome that you said 12? Because I know that's terribly incorrect. It is 46, brother.
Wow.
It's so good. So then here's what I beg to tell you, because this happened to Costco. It's had a crazy run the last 5 years. What if JP Morgan goes all blockchain and generates the same revenues with 150,000 employees instead of 330,000 employees? And their PE goes from 15, because that's what JP Morgan's forward PE is, 15. Don't you, doesn't it kind of make you want to buy XLF and just hold on to it for 5 to 10 years?
Well, there's more in the XLF than just JP Morgan, but if they're all at that level,
It trades
yeah,
at 18. It trades at 18 times. Not a recommendation, not a recommendation, but if it works out,
I
you
don't
know,
think we could.
started it.
Oh my God. You were so cocky now because you got your asset class of the year right. You're going on ETF of
Brother,
the year.
I guarantee you, even though I got that asset class right, you're gonna get 9 others correct. I'm
Well,
terrible
there's
at it.
still 2 more months. Hold your horses. You haven't won yet.
You're the one who, Brett, you're the one who brought it up.
Well, so far you've been right.
Look, the only reason that I came to that is because Costco is just hilarious stock to look at. Because if you get a Costco, you're thinking mid double digits max PE. And when you hear 44, 46, or 42, whatever it is, that's a shocking figure.
That's
So yes,
expensive.
Costco is in fact more expensive than Google, NVIDIA, Apple, and Microsoft.
Costco is that house down the street where they're selling it for $2 million, and you're just like, no way anyone's gonna buy it for $2 million.
Yeah, and they did it. Oh, that's fun. Thank you, Costco. Go buy a lot of toilet paper.
Alrighty. Till next
Until,
time.
until next time, sayonara.
See you all.